There are 17 trading chart patterns that appear most frequently, 10 of which are reversal patterns and 7 of them are continuation patterns. We will discuss these patterns one by one in this video. The double top reversal is a bearish reversal pattern typically found on bar charts, line charts, and candlestick charts. As its name implies, the pattern is made up of two consecutive peaks that are roughly equal, with a moderate trough in between. Note that a double top reversal on a bar or line chart is completely different from a double top breakout on a P and F chart. Namely, double top breakouts on P and F charts are bullish patterns that mark an upside resistance breakout. Although there can be variations, the classic double top reversal marks at least an intermediate term, if not long-term, change in trend from bullish to bearish. Many potential double top reversals can form along the way up, but until key support is broken, a reversal cannot be confirmed. For clarification, we will look at the key points in the formation and then walk through an example. Prior trend. With any reversal pattern, there must be an existing trend to reverse. In the case of the double top reversal, a significant uptrend of several months should be in place. First peak. The first peak should mark the highest point of the current trend. As such, the first peak is fairly normal and the uptrend is not in jeopardy, or in question, at this time. Trough. After the first peak, there is generally a decline of 10 to 20%. Volume on the decline from the first peak is usually inconsequential. The lows are sometimes rounded or drawn out a bit, which can be a sign of tepid demand. Second peak. The advance off the lows usually occurs with low volume and meets resistance from the previous high. Resistance from the previous high should be expected. Even after meeting resistance, only the possibility of a double top reversal exists. The pattern still needs to be confirmed. The time period between peaks can vary from a few weeks to many months, with the norm being 1 to 3 months. While exact peaks are preferable, there is some leeway. Usually, a peak within 3% of the previous high is adequate. Decline from peak. The subsequent decline from the second peak should witness an expansion in volume and/or an accelerated descent, perhaps marked with a gap or two. Such a decline shows that the forces of demand are weaker than supply and a support test is imminent. Support break. Even after trading down to support, the double top reversal and trend reversal are still not complete. Breaking support from the lowest point between the peaks completes the double top reversal. This too should occur with an increase in volume and/or an accelerated descent. Support turned resistance. Broken support becomes potential resistance, and there is sometimes a test of this newfound resistance level with a reaction rally. Such a test can offer a second chance to exit a position or initiate a short. Price target. The distance from support break to peak can be subtracted from the support break for a price target. This would infer that the bigger the formation is, the larger the potential decline. While the double top reversal formation may seem straightforward, technicians should take proper steps to avoid deceptive double top reversals. The peaks should be separated by about a month. If the peaks are too close, they could just represent normal resistance rather than a lasting change in the supply-demand picture. Ensure that the low between the peaks declines at least 10%. Declines less than 10% may not be indicative of a significant increase in selling pressure. After the decline, analyze the trough for clues on the strength of demand. If the trough drags on a bit and has trouble moving back up, demand could be drying up. When the security does advance, look for a contraction in volume as a further indication of weakening demand. Perhaps the most important aspect of a double top reversal is to avoid jumping the gun. Wait for support to be broken in a convincing manner, and usually with an expansion of volume. A price or time filter can be applied to differentiate between valid and false support breaks. A price filter might require a 3% support break before validation. A time filter might require the support break to hold for 3 days before considering it valid. The trend is in force until proven otherwise. This applies to the double top reversal as well. Until support is broken in a convincing manner, the trend remains up. The double bottom reversal is a bullish reversal pattern typically found on bar charts, line charts, and candlestick charts. As its name implies, the pattern is made up of 2 consecutive troughs that are roughly equal, with a moderate peak in between. Note that a double bottom reversal on a bar or line chart is completely different from double bottom breakdown on a P and F chart. Namely, double bottom breakdowns on P and F charts are bearish patterns that mark a downside support break. Although there can be variations, the classic double bottom reversal usually marks an intermediate or long-term change in trend. Many potential double bottom reversals can form during a downtrend, but until key resistance is broken, a reversal cannot be confirmed. To help clarify, we will look at the key points in the formation. Prior trend. With any reversal pattern, there must be an existing trend to reverse. In the case of the double bottom reversal, a significant downtrend of several months should be in place. First trough. The first trough should mark the lowest point of the current trend. As such, the first trough is fairly normal in appearance and the downtrend remains firmly in place. Peak. After the first trough, an advance takes place that typically ranges from 10 to 20%. Volume on the advance from the first trough is usually inconsequential, but an increase could signal early accumulation. The high of the peak is sometimes rounded or drawn out a bit from the hesitation to go back down. This hesitation indicates that demand is increasing, but still not strong enough for a breakout. Second trough. The decline off of the reaction high usually occurs with low volume and meets support from the previous low. Support from the previous low should be expected. Even after establishing support, only the possibility of a double bottom reversal exists, and it still needs to be confirmed. The time period between troughs can vary from a few weeks to many months, with the norm being 1 to 3 months. While exact troughs are preferable, there is some room to maneuver. Typically, a trough within 3% of its predecessor is considered valid. Advance from trough. Volume is more important for the double bottom reversal than the double top. There should be clear evidence that volume and buying pressure are accelerating during the advance off of the second trough. An accelerated ascent, perhaps marked with a gap or two, also indicates a potential change in sentiment. Resistance break. Even after trading up to resistance, the double top and trend reversal are still not complete. Breaking resistance from the highest point between the troughs completes the double bottom reversal. Like advances, these should occur with an increase in volume and/or an accelerated ascent. Resistance turns support. Broken resistance becomes potential support, and there is sometimes a test of this newfound support level with the first correction. Such a test can offer a second chance to close a short position or initiate a long. Price target. The distance from the resistance breakout to trough lows can be added on top of the resistance break to estimate a target. This would imply that the bigger the formation is, the larger the potential advance. It is important to remember that the double bottom reversal is an intermediate to long-term reversal pattern that will not form in a few days. Even though formation in a few weeks is possible, it is preferable to have at least 4 weeks between lows. Bottoms usually take longer to form than tops. Patience can often be a virtue. Give the pattern time to develop and look for the proper clues. The advance off of the first trough should be 10 to 20%. The second trough should form a low within 3% of the previous low, and volume on the ensuing advance should increase. Volume indicators such as check-in money flow, OBV, and accumulation distribution can be used to look for signs of buying pressure. Just as with the double top, it is paramount to wait for the resistance breakout. The formation is not complete until the previous reaction high is taken out. A head and shoulders reversal pattern forms after an uptrend, and its completion marks a trend reversal. The pattern contains 3 successive peaks, with the middle peak, head, being the highest and the 2 outside peaks, shoulders, being low and roughly equal. The reaction lows of each peak can be connected to form support, or a neckline. As its name implies, the head and shoulders reversal pattern is made up of a left shoulder, a head, a right shoulder, and a neckline. Other parts playing a role in the pattern are volume, the breakout, price target, and support turned resistance. We will look at each part individually. Prior trend. It is important to establish the existence of a prior uptrend for this to be a reversal pattern. Without a prior uptrend to reverse, there cannot be a head and shoulders reversal pattern, or any reversal pattern for that matter. Left shoulder. While in an uptrend, the left shoulder forms a peak that marks the high point of the current trend. After making this peak, a decline ensues to complete the formation of the shoulder. The low of the decline usually remains above the trend line, keeping the uptrend intact. Head. From the low of the left shoulder, an advance begins that exceeds the previous high and marks the top of the head. After peaking, the low of the subsequent decline marks the second point of the neckline. The low of the decline usually breaks the uptrend line, putting the uptrend in jeopardy. Right shoulder. The advance from the low of the head forms the right shoulder. This peak is lower than the head, a lower high, and usually in line with the high of the left shoulder. While symmetry is preferred, sometimes the shoulders can be out of whack. The decline from the peak of the right shoulder should break the neckline. Neckline. The neckline forms by connecting low points 1 and 2. Low point 1 marks the end of the left shoulder and the beginning of the head. Low point 2 marks the end of the head and the beginning of the right shoulder. Depending on the relationship between the 2 low points, the neckline can slope up, slope down, or be horizontal. The slope of the neckline will affect the pattern's degree of bearishness. A downward slope is more bearish than an upward slope. In some cases, multiple low points can be used to form the neckline. Volume. As the head and shoulders pattern unfolds, volume plays an important role in confirmation. Volume can be measured as an indicator, OBV, check-in money flow, or simply by analyzing volume levels. Ideally, but not always, volume during the advance of the left shoulder should be higher than during the advance of the head. Together, the decrease in volume and the new high of the head serve as a warning sign. The next warning sign comes when volume increases on the decline from the peak of the head, then decreases during the advance of the right shoulder. Final confirmation comes when volume further increases during the decline of the right shoulder. Neckline break. The head and shoulders pattern is not complete and the uptrend is not reversed until neckline support is broken. Ideally, this should also occur in a convincing manner, with an expansion in volume. Support turned resistance. Once support is broken, it is common for this same support level to turn into resistance. Sometimes, but certainly not always, the price will return to the support break and offer a second chance to sell. Price target. After breaking neckline support, the projected price decline is found by measuring the distance from the neckline to the top of the head. This distance is then subtracted from the neckline to reach a price target. Any price target should serve as a rough guide, and other factors should be considered as well. These factors might include previous support levels, Fibonacci retracements, or long-term moving averages. The head and shoulders pattern is one of the most common reversal formations. It is important to remember that it occurs after an uptrend and usually marks a major trend reversal when complete. While it is preferable that the left and right shoulders be symmetrical, it is not an absolute requirement. They can be different widths as well as different heights. Identification of neckline support and volume confirmation on the break can be the most critical factors. The support break indicates a new willingness to sell at lower prices. Lower prices combined with an increase in volume indicate an increase in supply. The combination can be lethal, and sometimes there is no second chance return to the support break. Measuring the expected length of the decline after the breakout can be helpful, but don't count on it for your ultimate target. As the pattern unfolds over time, other aspects of the technical picture are likely to take precedence. Inverse head and shoulders is a reversal pattern that shares many common characteristics with the head and shoulders top, but relies more heavily on volume patterns for confirmation. As a major reversal pattern, the head and shoulders bottom forms after a downtrend, with its completion marking a change in trend. The pattern contains 3 successive troughs, with the middle trough, head, being the deepest and the 2 outside troughs, shoulders, being shallower. Ideally, the 2 shoulders would be equal in height and width. The reaction highs in the middle of the pattern can be connected to form resistance or a neckline. The price action that forms the head and shoulders bottom is roughly the same as that which forms the head and shoulders top, but reversed. The role of volume marks the biggest difference between the two. Generally speaking, volume plays a larger role in bottom formations than top formations. While an increase in volume on the neckline breakout for a head and shoulders top is welcomed, it is absolutely required for a bottom. We will look at each part of the pattern individually. Keeping volume in mind. Prior trend. It is important to establish the existence of a prior downtrend for this to be a reversal pattern. Without a prior downtrend to reverse, there cannot be a head and shoulders bottom formation. Left shoulder. While in a downtrend, the left shoulder forms a trough that marks a new reaction low in the current trend. After forming this trough, an advance ensues to complete the formation of the left shoulder. The high of the advance usually remains below any longer trend line, thus keeping the downtrend intact. Head. From the high of the left shoulder, a decline begins that exceeds the previous low and forms the low point of the head. After making a bottom, the high of the subsequent advance forms the second point of the neckline. The high of the advance sometimes breaks a downtrend line, which calls into question the robustness of the downtrend. Right shoulder. The decline from the high of the head, neckline, begins to form the right shoulder. This low is always higher than the head, and it is usually in line with the low of the left shoulder. While symmetry is preferred, sometimes the shoulders can be out of whack, and the right shoulder will be higher, lower, wider, or narrower. When the advance from the low of the right shoulder breaks the neckline, the head and shoulders bottom reversal is complete. Neckline. The neckline forms by connecting reaction highs 1 and 2. Reaction high 1 marks the end of the left shoulder and the beginning of the head. Reaction high 2 marks the end of the head and the beginning of the right shoulder. Depending on the relationship between the 2 reaction highs, the neckline can slope up, slope down, or be horizontal. The slope of the neckline will affect the pattern's degree of bullishness. An upward slope is more bullish than a downward slope. Volume. While volume plays an important role in the head and shoulders top, it plays a crucial role in the head and shoulders bottom. Without the proper expansion of volume, the validity of any breakout becomes suspect. Volume can be measured as an indicator, OBV, check-in money flow, or simply by analyzing the absolute levels associated with each peak and trough. Volume levels during the first half of the pattern are less important than in the second half. Volume on the decline of the left shoulder is usually pretty heavy and selling pressure quite intense. The intensity of selling can even continue during the decline that forms the low of the head. After this low, subsequent volume patterns should be watched carefully to look for expansion during the advances. The advance from the low of the head should show an increase in volume and/or better indicator readings, e.g., CMF greater than 0 or rise in OBV. After the reaction high forms the second neckline point, the right shoulder's decline should be accompanied with light volume. It is normal to experience profit taking after an advance. Volume analysis helps distinguish between normal profit taking and heavy selling pressure. With light volume on the pullback, indicators like CMF and OBV should remain strong. The most important moment for volume occurs on the advance from the low of the right shoulder. For a breakout to be considered valid, there needs to be an expansion of volume on the advance and during the breakout. Neckline break. The head and shoulders bottom pattern is not complete, and the downtrend is not reversed until neckline resistance is broken. For a head and shoulders bottom, this must occur in a convincing manner. With an expansion of volume, resistance turns support. Once resistance is broken, it is common for this same resistance level to turn into support. Often, the price will return to the resistance break and offer a second chance to buy. Price target. After breaking neckline resistance, the projected advance is found by measuring the distance from the neckline to the bottom of the head. This distance is then added to the neckline to reach a price target. Any price target should serve as a rough guide, and other factors should be considered, as well. These factors might include previous resistance levels, Fibonacci retracements or long-term moving averages. The falling wedge is a bullish pattern that begins wide at the top and contracts as prices move lower. This price action forms a cone that slopes down as the reaction highs and reaction lows converge. In contrast to symmetrical triangles, which have no definitive slope and no bias, falling wedges definitely slope down and have a bullish bias. However, this bullish bias cannot be realized until a resistance breakout occurs. While this video will focus on the falling wedge as a reversal pattern, it can also fit into the continuation category. As a continuation pattern, the falling wedge will still slope down, but the slope will be against the prevailing uptrend. As a reversal pattern, the falling wedge slopes down and with the prevailing trend. Regardless of the type, reversal or continuation, falling wedges are regarded as bullish patterns. Prior trend. To qualify as a reversal pattern, there must be a prior trend to reverse. Ideally, the falling wedge will form after an extended downtrend and mark the final low. The pattern usually forms over a 3 to 6 month period, and the preceding downtrend should be at least 3 months old. Upper resistance line. It takes at least 2 reaction highs to form the upper resistance line, ideally 3. Each reaction high should be lower than the previous highs. Lower support line. At least 2 reaction lows are required to form the lower support line. Each reaction low should be lower than the previous lows. Contraction. The upper resistance line and lower support line converge to form a cone as the pattern matures. The reaction lows still penetrate the previous lows, but this penetration becomes shallower. Shallower lows indicate a decrease in selling pressure and create a lower support line with less negative slope than the upper resistance line. Resistance break. Bullish confirmation of the pattern does not come until the resistance line is broken in convincing fashion. It is sometimes prudent to wait for a break above the previous reaction high for further confirmation. Once resistance is broken, there can sometimes be a correction to test the newfound support level. Volume. While volume is not particularly important on rising wedges, it is an essential ingredient to confirm a falling wedge breakout. Without an expansion of volume, the breakout will lack conviction and be vulnerable to failure. As with rising wedges, the falling wedge can be one of the most difficult chart patterns to accurately recognize and trade. When lower highs and lower lows form, as in a falling wedge, a security remains in a downtrend. The falling wedge is designed to spot a decrease in downside momentum and alert technicians to a potential trend reversal. Even though selling pressure may be diminishing, demand does not win out until resistance is broken. As with most patterns, it is important to wait for a breakout and combine other aspects of technical analysis to confirm signals. The rising wedge is a bearish pattern that begins wide at the bottom and contracts as prices move higher and the trading range narrows. In contrast to symmetrical triangles, which have no definitive slope and no bullish or bearish bias, rising wedges definitely slope up and have a bearish bias. While though this video will focus on the rising wedge as a reversal pattern, the pattern can also fit into the continuation category. As a continuation pattern, the rising wedge will still slope up, but the slope will be against the prevailing downtrend. As a reversal pattern, the rising wedge will slope up and with the prevailing trend. Regardless of the type, reversal or continuation, rising wedges are bearish. Prior trend. In order to qualify as a reversal pattern, there must be a prior trend to reverse. The rising wedge usually forms over a 3 to 6 month period and can mark an intermediate or long-term trend reversal. Sometimes the current trend is totally contained within the rising wedge. Other times the pattern will form after an extended advance. Upper resistance line. It takes at least 2 reaction highs to form the upper resistance line, ideally 3. Each reaction high should be higher than the previous high. Lower support line. At least 2 reaction lows are required to form the lower support line. Each reaction low should be higher than the previous low. Contraction. The upper resistance line and lower support line converge as the pattern matures. The advances from the reaction lows, lower support line, become shorter and shorter, which makes the rallies unconvincing. This creates an upper resistance line that fails to keep pace with the slope of the lower support line and indicates a supply overhang as prices increase. Support break. Bearish confirmation of the pattern does not come until the support line is broken in a convincing fashion. It is sometimes prudent to wait for a break of the previous reaction low. Once support is broken, there can sometimes be a reaction rally to test the newfound resistance level. Volume. Ideally, volume will decline as prices rise and the wedge evolves. An expansion of volume on the support line break can be taken as bearish confirmation. The rising wedge can be one of the most difficult chart patterns to accurately recognize and trade. While it is a consolidation formation, the loss of upside momentum on each successive high gives the pattern its bearish bias. However, the series of higher highs and higher lows keeps the trend inherently bullish. The final break of support indicates that the forces of supply have finally won out and lower prices are likely. There are no measuring techniques to estimate the decline. Other aspects of technical analysis should be employed to forecast price targets. The rounding bottom is a long-term reversal pattern that is best suited for weekly charts. It is also referred to as a saucer bottom, and represents a long consolidation period that turns from a bearish bias to a bullish bias. Prior trend. In order to be a reversal pattern, there must be a prior trend to reverse. Ideally, The low of a rounding bottom will mark a new low or reaction low. In practice, there are occasions when the low is recorded many months earlier and the security trades flat before forming the pattern. When the rounding bottom does finally form, its low may not be the lowest low of the last few months. Decline. The first portion of the rounding bottom is the decline that leads to the low of the pattern. This decline can take on different forms. Some are quite jagged with a number of reaction highs and lows, while others trade lower in a more linear fashion. Low. The low of the rounding bottom can resemble a V bottom, but should not be too sharp and should take a few weeks to form. Because prices are in a long-term decline, the possibility of a selling climax exists that could create a lower spike. Advance. The advance off of the lows forms the right half of the pattern and should take about the same amount of time as the prior decline. If the advance is too sharp, then the validity of a rounding bottom may be in question. Breakout. Bullish confirmation comes when the pattern breaks above the reaction high that marked the beginning of the decline at the start of the pattern. As with most resistance breakouts, this level can become support. However, rounding bottoms represent long-term reversal and this new support level may not be that significant. Volume. In an ideal pattern, volume levels will track the shape of the rounding bottom. High at the beginning of the decline, low at the end of the decline and rising during the advance. Volume levels are not too important on the decline, but there should be an increase in volume on the advance and preferably on the breakout. A rounding bottom could be thought of as a head and shoulders bottom without readily identifiable shoulders. The head represents the low and is fairly central to the pattern. The volume levels throughout the pattern mimic those of the head and shoulders bottom. Confirmation comes with a resistance breakout. While symmetry is preferable on the rounding bottom, the left and right side do not have to be equal in time or slope. The important thing is to capture the essence of the pattern. The triple top reversal is a bearish reversal pattern typically found on bar charts, line charts and candlestick charts. There are 3 equal highs followed by a break below support. As major reversal patterns, these patterns usually form over a 3 to 6 month period. Note that a triple top reversal on a bar or line chart is completely different from triple top breakout on a P&F chart. Namely, triple top breakouts on P&F charts are bullish patterns that mark an upside resistance breakout. We will first examine the individual parts of the pattern and then look at an example. Prior trend. With any reversal pattern, there should be an existing trend to reverse. In the case of the triple top reversal, an uptrend should precede the formation. 3 highs. All 3 highs should be reasonably equal, well-spaced and mark clear turning points to establish resistance. The highs do not have to be exactly equal, but should be reasonably equivalent to each other. Volume. As the triple top reversal develops, overall volume levels usually decline. Volume sometimes increases near the highs. After the 3rd high, an expansion of volume on the subsequent decline and at the support break greatly reinforces the soundness of the pattern. Support break. As with many other reversal patterns, the triple top reversal is not complete until a support break. The lowest point of the formation, which would be the lowest of the intermittent lows, marks this key support level. Support turns resistance. Broken support becomes potential resistance, and there is sometimes a test of this newfound resistance level with a subsequent reaction rally. Price target. The distance from the support break to the highs can be measured and subtracted from the support break for a price target. The longer the pattern develops, the more significant the ultimate break. Triple top reversals that are 6 or more months old represent major tops and a price target is less likely to be effective. Throughout the development of the triple top reversal, It can start to resemble a number of other patterns. Before the third high forms, the pattern may look like a double top reversal. 3 equal highs can also be found in an ascending triangle or rectangle. Of these patterns mentioned, only the ascending triangle has bullish overtones, the others are neutral until a break occurs. In this same vein, the triple top reversal should also be treated as a neutral pattern until a breakdown occurs. The inability to break above resistance is bearish. But the bears have not won the battle until support is broken. Volume on the last decline off resistance can sometimes yield a clue. If there is a sharp increase in volume and momentum, then the chances of a support break increase. The triple bottom reversal is a bullish reversal pattern typically found on bar charts, line charts and candlestick charts. There are 3 equal lows followed by a break above resistance. As major reversal patterns, these patterns usually form over a 3 to 6 month period. Note that a triple bottom reversal on a bar or line chart is completely different from triple bottom breakdown on a P and F chart. Namely, triple bottom breakouts on P and F charts are bearish patterns that mark a downside support break. We will first examine the individual parts of the pattern and then look at an example. Prior trend. With any reversal pattern, there should be an existing trend to reverse. In the case of the triple bottom reversal, a clear downtrend should precede the formation. 3 lows. All 3 lows should be reasonably equal, well-spaced and mark significant turning points. The lows do not have to be exactly equal, but should be reasonably equivalent. Volume. As the triple bottom reversal develops, overall volume levels usually decline. Volume sometimes increases near the lows. After the third low, an expansion of volume on the advance and at the resistance breakout greatly reinforces the soundness of the pattern. Resistance break. As with many other reversal patterns, the triple bottom reversal is not complete until a resistance breakout. The highest point of the formation, which would be the highest of the intermittent highs, marks resistance. Resistance turns support. Broken resistance becomes potential support, and there is sometimes a test of this newfound support level with the first correction. Price target. The distance from the resistance breakout to lows can be measured and added to the resistance break for a price target. The longer the pattern develops, the more significant is the ultimate breakout. Triple bottom reversals that are 6 or more months in duration represent major bottoms, and a price target is less likely to be effective. As the triple bottom reversal develops, it can start to resemble a number of patterns. Before the third low forms, the pattern may look like a double bottom reversal. 3 equal lows can also be found in a descending triangle or rectangle. Of these patterns mentioned, only the descending triangle has bearish overtones, the others are neutral until a breakout occurs. Similarly, the triple bottom reversal should also be treated as a neutral pattern until a breakout occurs. The ability to hold support is bullish, but demand has not won the battle until resistance is broken. Volume on the last advance can sometimes yield a clue. If there is a sharp increase in volume and momentum, then the chances of a breakout increase. As the name implies, the bump and run reversal, BAR, is a reversal pattern that forms after excessive speculation drives prices up too far, too fast. Developed by Thomas Bulkowski. The pattern was introduced in the June 97 issue of Technical Analysis of Stocks and Commodities and also included in his book, The Encyclopedia of Chart Patterns. The pattern was originally named the Bump and Run Formation, or BARF. Bulkowski decided that Wall Street was not ready for such an acronym and changed the name to Bump and Run Reversal. Bulkowski identified 3 main phases to the pattern: lead in, bump, and run. We will examine these phases and also look at volume and pattern validation. Lead-in phase. The first part of the pattern is a lead-in phase that can last 1 month or longer and forms the basis from which to draw the trend line. During this phase, prices advance in an orderly manner and there is no excess speculation. The trend line should be moderately steep. If it is too steep, then the ensuing bump is unlikely to be significant enough. If the trend line is not steep enough, then the subsequent trend line break will occur too late. Bulkowski advises that an angle of 30 to 45 degrees is preferable. The size of the angle will depend on the scaling, semi-log or arithmetic, and the size of the chart. It is probably easier to judge the soundness of the trend line with a visual assessment. Bump phase. The bump forms with a sharp advance, and prices move further away from the lead-in trend line. Ideally, the angle of the trend line from the bump's advance should be about 50% greater than the angle of the trend line extending up from the lead-in phase. Roughly speaking, this would call for an angle between 45 and 60 degrees. If it is not possible to measure the angles, then a visual assessment will suffice. Bump validity. It is important that the bump represent a speculative advance that cannot be sustained for a long time. Bulkowski developed what he calls an arbitrary measuring technique to validate the level of speculation in the bump. The distance from the highest high of the bump to the lead-in trend line should be at least twice the distance from the highest high in the lead-in phase to the lead-in trend line. These distances can be measured by drawing a vertical line from the highest highs to the lead-in trend line. An example is provided in the chart below. Bump rollover. After speculation dies down, prices begin to peak and a top forms. Sometimes, a small double top or a series of descending peaks forms instead. Prices begin to decline towards the lead-in trend line, and the right side of the bump forms. Volume. As the stock advances during the lead-in phase, volume is usually average and sometimes low. When the speculative advance begins to form the left side of the bump, volume expands as the advance accelerates. Run phase. The run phase begins when the pattern breaks support from the lead-in trend line. Prices will sometimes hesitate or bounce off the trend line before breaking through. Once the break occurs, the run phase takes over and the decline continues. Support turns resistance. After the trend line is broken, there is sometimes a retracement that tests the newfound resistance level. Potential support turned resistance levels can also be identified from the reaction lows within the bump. The bump and run reversal pattern can be applied to daily, weekly, or monthly charts. As stated above, the pattern is designed to identify speculative advances that are unsustainable for a long period. Because prices rise very fast to form the left side of the bump, the subsequent decline can be just as ferocious. Flags and pennants are short-term continuation patterns that mark a small consolidation before the previous move resumes. These patterns are usually preceded by a sharp advance or decline with heavy volume and mark a midpoint of the move. Sharp move. To be considered a continuation pattern, there should be evidence of a prior trend. Flags and pennants require evidence of a sharp advance or decline on heavy volume. These moves usually occur on heavy volume and can contain gaps. This move usually represents the first leg of a significant advance or decline, and the flag pennant is merely a pause. Flagpole. The flagpole is the distance from the first resistance or support break to the high or low of the flag pennant. The sharp advance or decline that forms the flagpole should break a trend line or resistance support level. A line extending up from this break to the high of the flag pennant forms the flagpole. Flag. A flag is a small rectangle pattern that slopes against the previous trend. If the previous move was up, then the flag would slope down. If the move was down, then the flag would slope up. Because flags are usually too short in duration to actually have reaction highs and reaction lows, the price action just needs to be contained within two parallel trend lines. Pennant. A pennant is a small symmetrical triangle that begins wide and converges as the pattern matures, like a cone. The slope is usually neutral. Sometimes there will not be specific reaction highs and lows from which to draw the trend lines, and the price action should just be contained within the converging trend lines. Duration. Flags and pennants are short-term patterns that can last from 1 to 12 weeks. There is some debate on the time frame, and some consider 8 weeks to be pushing the limits for a reliable pattern. Ideally, these patterns will form between 1 and 4 weeks. Once a flag becomes more than 12 weeks old, it would be classified as a rectangle. A pennant more than 12 weeks old would turn into a symmetrical triangle. The reliability of patterns that fall between 8 and 12 weeks is debatable. Break. For a bullish flag or pennant, a break above resistance signals that the previous advance has resumed. For a bearish flag or pennant, a break below support signals that the previous decline has resumed. Volume. Volume should be heavy during the advance or decline that forms the flagpole. Heavy volume provides legitimacy for the sudden and sharp move that creates the flagpole. An expansion of volume on the resistance, support, break lends credence to the validity of the formation and the likelihood of continuation. Targets. The length of the flagpole can be applied to the resistance break or support break of the flag, pennant to estimate the advance or decline. Even though flags and pennants are common formations, identification guidelines should not be taken lightly. It is important that flags and pennants are preceded by a sharp advance or decline. Without a sharp move, the reliability of the formation becomes questionable and trading could carry added risk. Look for volume confirmation on the initial move, consolidation and resumption to augment the robustness of pattern identification. The symmetrical triangle, which can also be referred to as a coil, usually forms during a trend as a continuation pattern. The pattern contains at least 2 lower highs and 2 higher lows. When these points are connected, the lines converge as they are extended and the symmetrical triangle takes shape. You could also think of it as a contracting wedge, wide at the beginning and narrowing over time. While there are instances when symmetrical triangles mark important trend reversals, they more often mark a continuation of the current trend. Regardless of the nature of the pattern, continuation or reversal, the direction of the next major move can only be determined after a valid breakout. We will examine each part of the symmetrical triangle individually. Trend. In order to qualify as a continuation pattern, an established trend, at least a few months old, should exist. The symmetrical triangle marks a consolidation period before continuing after the breakout. 4 points. At least 2 points are required to form a trend line and 2 trend lines are required to form a symmetrical triangle. Therefore, a minimum of 4 points are required to begin considering a formation as a symmetrical triangle. The second high, 2, should be lower than the first, 1, and the upper line should slope down. The second low, 2, should be higher than the first, 1, and the lower line should slope up. Ideally, the pattern will form with 6 points, 3 on each side, before a breakout occurs. Volume. As the symmetrical triangle extends and the trading range contracts, volume should start to diminish. This refers to the quiet before the storm, or the tightening consolidation before the breakout. Duration. The symmetrical triangle can extend for a few weeks or many months. If the pattern is less than 3 weeks, it is usually considered a pennant. Typically, the time duration is about 3 months. Breakout time frame. The ideal breakout point occurs 1/2 to 3/4 of the way through the pattern's development or time span. The time span of the pattern can be measured from the apex, convergence of upper and lower lines, back to the beginning of the lower trend line, base. A break before the 1/2 way point might be premature, and a break too close to the apex may be insignificant. After all, as the apex approaches, a breakout must occur sometime. Breakout direction. The future direction of the breakout can only be determined after the break has occurred. Sounds obvious enough, but attempting to guess the direction of the breakout can be dangerous. Even though a continuation pattern is supposed to break out in the direction of the long-term trend, this is not always the case. Breakout confirmation. A break should be on a closing basis for it to be considered valid. Some traders apply a price, 3% break, or time, sustained for 3 days, filter to confirm validity. The breakout should occur with an expansion in volume, especially on upside breakouts. Return to apex. After the breakout, up or down, the apex can turn into future support or resistance. The price sometimes returns to the apex or a support-resistance level around the breakout before resuming in the direction of the breakout. Price target. There are two methods to estimate the extent of the move after the breakout. First, the widest distance of the symmetrical triangle can be measured and applied to the breakout point. Second, a trend line can be drawn parallel to the pattern's trend line that slopes, up or down, in the direction of the break. The extension of this line will mark a potential breakout target. In Technical Analysis of Stock Trends, 1948, Edwards and McGee suggest that roughly 75% of symmetrical triangles are continuation patterns and the rest mark reversals. The reversal patterns can be especially difficult to analyze and often have false breakouts. Even so, we should not anticipate the direction of the breakout, but rather wait for it to happen. Further analysis should be applied to the breakout by looking for gaps, accelerated price movements, and volume for confirmation. Confirmation is especially important for upside breakouts. Prices sometimes return to the breakout point of apex on a reaction move before resuming in the direction of the breakout. This return can offer a second chance to participate with a better reward-to-risk ratio. Potential reward price targets found by measurement and parallel trend line extension are only meant to act as rough guidelines. The ascending triangle is a bullish formation that usually forms during an uptrend as a continuation pattern. There are instances when ascending triangles form as reversal patterns at the end of a downtrend, but they are typically continuation patterns. Regardless of where they form, ascending triangles are bullish patterns that indicate accumulation. Because of its shape, the pattern can also be referred to as a right-angle triangle. Two or more equal highs form a horizontal line at the top. Two or more rising troughs form an ascending trend line that converges on the horizontal line as it rises. If both lines were extended right, the ascending trend line could act as the hypotenuse of a right triangle. If a perpendicular line were drawn extending down from the left end of the horizontal line, a right triangle would form. Let's examine each individual part of the pattern and then look at an example. Trend. In order to qualify as a continuation pattern, an established trend should exist. However, because the ascending triangle is a bullish pattern, the length and duration of the current trend is not as important as the robustness of the formation, which is paramount. Top horizontal line. At least two reaction highs are required to form the top horizontal line. The highs do not have to be exact, but they should be within reasonable proximity of each other. There should be some distance between the highs and a reaction low between them. Lower ascending trend line. At least two reaction lows are required to form the lower ascending trend line. These reaction lows should be successively higher, and there should be some distance between the lows. If a more recent reaction low is equal to or less than the previous reaction low, then the ascending triangle is not valid. Duration. The length of the pattern can range from a few weeks to many months, with the average pattern lasting from 1 to 3 months. Volume. As the pattern develops, volume usually contracts. When the upside breakout occurs, there should be an expansion of volume to confirm the breakout. While volume confirmation is preferred, it is not always necessary. Return to breakout. A basic tenet of technical analysis is that resistance turns into support and vice versa. When the horizontal resistance line of the ascending triangle is broken, it turns into support. Sometimes there will be a return to this support level before the move begins in earnest. Target. Once the breakout has occurred, the price projection is found by measuring the widest distance of the pattern and applying it to the resistance breakout. In contrast to the symmetrical triangle, an ascending triangle has a definitive bullish bias before the actual breakout. If you will recall, the symmetrical triangle is a neutral formation that relies on the impending breakout to dictate the direction of the next move. On the ascending triangle, the horizontal line represents overhead supply that prevents the security from moving past a certain level. It is as if a large sell order has been placed at this level and it is taking a number of weeks or months to execute, thus preventing the price from rising further. Even though the price cannot rise past this level, the reaction lows continue to rise. It is these higher lows that indicate increased buying pressure and give the ascending triangle its bullish bias. The descending triangle is a bearish formation that usually forms during a downtrend as a continuation pattern. There are instances when descending triangles form as reversal patterns at the end of an uptrend, but they are typically continuation patterns. Regardless of where they form, descending triangles are bearish patterns that indicate distribution. Because of its shape, the pattern can also be referred to as a right-angle triangle. Two or more comparable lows form a horizontal line at the bottom. Two or more declining peaks form a descending trend line above that converges with the horizontal line as it descends. If both lines were extended right, the descending trend line could act as the hypotenuse of a right triangle. If a perpendicular line were drawn extending up from the left end of the horizontal line, a right triangle would form. Let's examine each individual part of the pattern and then look at an example. Trend. In order to qualify as a continuation pattern, an established trend should exist. However, because the descending triangle is definitely a bearish pattern, the length and duration of the current trend is not as important as the robustness of the formation. Lower horizontal line. At least two reaction lows are required to form the lower horizontal line. The lows do not have to be exact, but should be within reasonable proximity of each other. There should be some distance separating the lows and a reaction high between them. Upper descending trend line. At least two reaction highs are required to form the upper descending trend line. These reaction highs should be successively lower and there should be some distance between the highs. If a more recent reaction high is equal to or greater than the previous reaction high, then the descending triangle is not valid. Duration. The length of the pattern can range from a few weeks to many months, with the average pattern lasting from 1 to 3 months. Volume. As the pattern develops, volume usually contracts. When the downside break occurs, there would ideally be an expansion of volume for confirmation. While volume confirmation is preferred, it is not always necessary. Return to breakout. A basic tenet of technical analysis is that broken support turns into resistance and vice versa. When the horizontal support line of the descending triangle is broken, it turns into resistance. Sometimes there will be a return to this newfound resistance level before the down move begins in earnest. Target. Once the breakout has occurred, the price projection is found by measuring the widest distance of the pattern and subtracting it from the resistance breakout. In contrast to the symmetrical triangle, a descending triangle has a definite bearish bias before the actual break. The symmetrical triangle is a neutral formation that relies on the impending breakout to dictate the direction of the next move. For the descending triangle, the horizontal line represents demand that prevents the security from declining past a certain level. It is as if a large buy order has been placed at this level and it is taking a number of weeks or months to execute, thus preventing the price from declining further. Even though the price does not decline past this level, the reaction highs continue to decline. It is these lower highs that indicate increased selling pressure and give the descending triangle its bearish bias. A rectangle is a continuation pattern that forms as a trading range during a pause in the trend. The pattern is easily identifiable by two comparable highs and two comparable lows. The highs and lows can be connected to form two parallel lines that make up the top and bottom of a rectangle. Rectangles are sometimes referred to as trading ranges. Consolidation zones are congestion areas. There are many similarities between the rectangle and the symmetrical triangle, while both are usually continuation patterns. They can also mark trends' significant tops and bottoms. As with the symmetrical triangle, the rectangle pattern is not complete until a breakout has occurred. Sometimes clues can be found, but the direction of the breakout is usually not determinable beforehand. We will examine each part of the rectangle. Trend. To qualify as a continuation pattern, a prior trend should exist. Ideally, the trend should be a few months old and not too mature. The more mature the trend, the less chance that the pattern marks a continuation. 4 points. At least two equivalent reaction highs are required to form the upper resistance line and two equivalent reaction lows to form the lower support line. They do not have to be exactly equal, but should be within a reasonable proximity. Although not a prerequisite, it is preferable that the highs and lows alternate. Volume. As opposed to the symmetrical triangle, rectangles do not exhibit standard volume patterns. Sometimes volume will decline as the pattern develops. Other times, volume will gyrate as the prices bounce between support and resistance. Volume will rarely increase as the pattern matures. If volume declines, it is best to look for an expansion on the breakout for confirmation. If volume gyrates, it is best to assess which movements, advances to resistance or declines to support, are receiving the most volume. This type of volume assessment could offer an indication on the direction of the future breakout. Duration. Rectangles can extend for a few weeks or many months. If the pattern is less than 3 weeks, it is usually considered a flag, also a continuation pattern. Ideally, rectangles will develop over a 3-month period. Generally, the longer the pattern, the more significant the breakout. A 3-month pattern might be expected to fulfill its breakout projection. However, a 6-month pattern might be expected to exceed its breakout target. Breakout direction. The direction of the next significant move can only be determined after the breakout has occurred. As with the symmetrical triangle, rectangles are neutral patterns that are dependent on the direction of the future breakout. Volume patterns can sometimes offer clues, but there is no confirmation until an actual break above resistance or break below support. Breakout confirmation. For a breakout to be considered valid, it should be on a closing basis. Some traders apply a filter to price, which is 3%, time, which is 3 days, or volume, expansion, for confirmation. Return to breakout. A basic tenet of technical analysis is that broken support turns into potential resistance and vice versa. After a break above resistance, or below support, there is sometimes a return to test this newfound support level, or resistance level. For more detail, see our videos in the playlist. A return to or near the original breakout level can offer a second chance to participate. Target. The estimated move is found by measuring the height of the rectangle and applying it to the breakout. Rectangles represent a trading range that pits the bulls against the bears. As the price nears support, buyers step in and push the price higher. As the price nears resistance, bears take over and force the price lower. Nimble traders sometimes play these bounces by buying near support and selling near resistance. One group, bulls or bears, will exhaust itself and a winner will emerge when there is a breakout. Again, it is important to remember that rectangles have a neutral bias. Even though clues can sometimes be gleaned from volume patterns, the actual price action depicts a market in conflict. Only until the price breaks above resistance or below support will it be clear which group has won the battle. A price channel is a continuation pattern that slopes up or down and is bound by an upper and lower trend line. The upper trend line marks resistance and the lower trend line marks support. Price channels with negative slopes, down, are considered bearish and those with positive slopes, up, bullish. For explanatory purposes, a bullish price channel will refer to a channel with positive slope and a bearish price channel will refer to a channel with negative slope. Main trend line. It takes at least 2 points to draw the main trend line. This line sets the tone for the trend in the slope. For a bullish price channel, the main trend line extends up and at least 2 reaction lows are required to draw it. For a bearish price channel, the main trend line extends down and at least 2 reaction highs are required to draw it. Channel line. The line drawn parallel to the main trend line is called the channel line. Ideally, the channel line will be based off of 2 reaction highs or reaction lows. However, after the main trend line has been established, some analysts draw the parallel channel line using only 1 reaction high or low. The channel line marks support in a bearish price channel and resistance in a bullish price channel. Bullish price channel. As long as prices advance and trade within the channel, the trend is considered bullish. The first warning of a trend change occurs when prices fall short of channel line resistance. A subsequent break below main trend line support would provide further indication of a trend change. A break above channel line resistance would be bullish and indicate an acceleration of the advance. Bearish price channel. As long as prices decline and trade within the channel, the trend is considered bearish. The first warning of a trend change occurs when prices fail to reach channel line support. A subsequent break above main trend line resistance would provide further indication of a trend change. A break below channel line support would be bearish and indicate an acceleration of the decline. Scaling. Even though it is a matter of personal preference, trend lines seem to match reaction highs and lows best when semi-log scales are used. Semi-log scales reflect price movements in percentage terms. A move from 50 to 100 will appear the same distance as a move from 100 to 200. In a bullish price channel, some traders look to buy when prices reach main trendline support. Conversely, some traders look to sell, or short, when prices reach main trendline resistance in a bearish price channel. As with most price patterns, other aspects of technical analysis should be used to confirm signals. Because technical analysis is just as much art as it is science, there is room for flexibility. Even though exact trendline touches are ideal, it is up to each individual to judge the relevance and placement of both the main trend line and the channel line. By that same token, A channel line that is exactly parallel to the main trend line is ideal. The cup with handle is a bullish continuation pattern that marks a consolidation period followed by a breakout. It was developed by William O'Neill and introduced in his 1988 book, How to Make Money in Stocks. As its name implies, there are two parts to the pattern, the cup and the handle. The cup forms after an advance and looks like a bowl or rounding bottom. As the cup is completed, a trading range develops on the right-hand side and the handle is formed. A subsequent breakout from the handle's trading range signals a continuation of the prior advance. Trend. To qualify as a continuation pattern, a prior trend should exist. Ideally, the trend should be a few months old and not too mature. The more mature the trend, the less chance that the pattern marks a continuation or the less upside potential. Cup. The cup should be U-shaped and resemble a bowl or rounding bottom. A V-shaped bottom would be considered too sharp of a reversal to qualify. The softer U shape ensures that the cup is a consolidation pattern with valid support at the bottom of the U. The perfect pattern would have equal highs on both sides of the cup, but this is not always the case. Cup depth. Ideally, the depth of the cup should retrace 1/3 or less of the previous advance. However, with volatile markets and overreactions, the retracement could range from 1/3 to 1/2. In extreme situations, the maximum retracement could be 2/3, which conforms with Dow theory. Handle. After the high forms on the right side of the cup, there is a pullback that forms the handle. Sometimes this handle resembles a flag or pennant that slopes downward. Other times it is just a short pullback. The handle represents the final consolidation, pullback before the big breakout and can retrace up to 1/3 of the cup's advance, but usually not more. The smaller the retracement, the more bullish the formation and significant the breakout. Sometimes it is prudent to wait for a break above the resistance line established by the highs of the cup. Duration. The cup can extend from 1 to 6 months, sometimes longer on weekly charts. The handle can be from 1 week to many weeks and ideally completes within 1 to 4 weeks. Volume. There should be a substantial increase in volume on the breakout above the handle's resistance. Target. The projected advance after breakout can be estimated by measuring the distance from the right peak of the cup to the bottom of the cup. As with most chart patterns, it is more important to capture the essence of the pattern than the particulars. The cup is a bowl-shaped consolidation and the handle is a short pullback followed by a breakout with expanding volume. A cup retracement of 62% may not fit the pattern requirements, but a particular stock's pattern may still capture the essence of the cup with handle.